Most people will spend the best years of their lives working for money they will never truly own. They will trade time for a paycheck. They will spend that paycheck before it settles. They will borrow against a future they haven't built yet. And then, one day, somewhere in their 40s or 50s, they will look at their bank account and feel a quiet, devastating kind of confusion because they worked hard. They did everything they were told. They showed up. They paid their bills. And still, somehow the numbers never grew into something that felt like freedom. This is not a story about laziness. This is not a story about lack of effort. This is a story about what happens when a person works hard in the wrong direction, for the wrong reasons without the right framework for thinking about money. And this is what most schools never teach, what most parents, through no fault of their own, never explained, what the financial industry has little incentive to share. There is a way of thinking about wealth that most people never encounter. A set of principles so disciplined, so patient, so deeply rooted in logic and human psychology that the people who internalize them early almost always end up in a fundamentally different position than those who do not. This video is about those principles, not as a shortcut, not as a system you follow for 90 days and abandon, but as a permanent shift in how you see money, time, and the decisions you make every single day. If you had heard these ideas at 18, your life might look different today. If you absorb them now, the next decade might surprise you in ways you cannot yet imagine. There is a version of you that is financially stuck right now. And it is not because of bad luck, though luck plays a role in everything. It is not because the economy is unfair, though fairness is never guaranteed. The version of you that is financially stuck is largely a product of the way you feel about money, not the way you think about it. This is the part almost no one wants to hear. Most financial decisions are not made with a spreadsheet. They are made with emotion, fear, excitement, social pressure, the desire to appear successful before actually being successful, the need to feel good today at the cost of something better tomorrow. When markets rise sharply and everyone around you seems to be getting rich, the emotional pull toward buying is nearly irresistible. When markets fall and every headline screams disaster, the emotional pull toward selling is equally powerful. And both of those impulses, acting at exactly the wrong moments, are the primary reason most investors underperform over their lifetimes. This is not a character flaw. It is biology. The human brain was not designed to think in decades. It was designed to survive the next hour, the next season, the next threat. Short-term thinking kept our ancestors alive. In the context of wealth building, that same wiring becomes a liability. The person who buys a stock because they saw it trending online is not investing. They are gambling with extra steps. The person who sells at a loss during a market correction because they can no longer tolerate the anxiety is not being cautious. They are locking in a loss because their nervous system demanded relief. And then there is the trap that most employed people live inside without ever naming it. You wake up, you go to work, you produce value for someone else's business. You receive a portion of that value back as a salary. You spend most of that salary to maintain the lifestyle that the salary made possible. You return to work the next morning to repeat the cycle. This is not inherently wrong. Work is dignified. Employment is a legitimate and often fulfilling part of life. But if the work is the only engine generating financial growth, if nothing is being set aside to grow independently of your labor, then the day you stop working is the day your financial progress stops entirely. The uncomfortable truth is that a salary, no matter how large, is a fragile foundation. Companies restructure, industries shift, health changes, the world moves, and the person who has booze their financial life entirely on the next paycheck is always at some level one unexpected event away from starting over. This is the employee trap. Not employment itself, but the assumption that employment is sufficient. That showing up and being paid is the whole of what financial life requires. Add to this the quiet accelerant of lifestyle inflation, and the picture becomes even more difficult. As income grows, spending tends to grow with it. The better apartment, the newer car, the more expensive restaurants, the wardrobe that reflects the position, none of these things are inherently wrong either. But when every increase in income is immediately absorbed by an increase in expenses, the gap between what you earn and what you keep never widens. And it is only in that gap, that margin between income and expenditure, where wealth is actually built. The person earning a modest income who consistently saves and invests a meaningful portion of it will over time accumulate more genuine wealth than the high earner who expands their lifestyle with every raise. This is not theoretical. The mathematics of compounding make it almost inevitable. This brings us to the principle at the center of everything. Warren Buffett has described his approach to investing as something he understood deeply by the time he was in his mid-20s. Not a sophisticated formula, not a proprietary algorithm, but a way of thinking so clear and so consistent that it has produced results across nearly 7 decades. At its core, the principle is this: a dollar today is not worth a dollar. It is worth every dollar that dollar could become if given time, the right vehicle, and the patience to leave it alone. This sounds simple, and it is simple. But there is a profound difference between understanding something intellectually and living according to it. Buffett came to understand compounding not as an investment strategy, but as a fundamental truth about how value accumulates over time. He understood that the earliest dollars, the ones set aside in your 20s or your 30s, are not just dollars, they are seeds. And a seed planted early enough in soil that is left undisturbed becomes something entirely different from what was originally planted. He reportedly calculated as a young man the future cost of every dollar he spent. Not in a tormented, joyless way, but as a genuine cognitive habit. If spending this dollar today means not having it available to compound over the next 40 years, what is the true cost of that purchase? The answer, in many cases, was an order of magnitude larger than the sticker price. This is not an argument for miserliness. It is an argument for consciousness, for understanding what you are actually trading when you make a financial decision. Ion, most people experience money as a static resource. They have some, they spend some, they get more. The transaction feels complete, but money in motion, money that is working, growing, compounding, is not static at all. It is alive in a very specific economic sense. And the person who treats it that way from an early age is playing an entirely different game than the person who does not. The first lesson that flows directly from this understanding is the power of beginning before you feel ready. Most people wait. They tell themselves they will start investing when they have more disposable income, when the debts are paid down, when the market is less volatile, when the timing feels right, and these justifications are not dishonest. They feel genuinely reasonable in the moment, but every year of waiting is not a neutral act. It is a cost. The compounding that could have begun is compounding that did not begin. And because of the mathematics involved, the exponential rather than linear nature of long-term growth, the years at the beginning of the timeline are worth far more than the years at the end. Consider the difference between someone who begins investing in their early 20s versus someone who begins in their mid-30s. Even if the late starter contributes significantly more money in total, the early starter often ends up with more simply because those initiate. Our years had longer to compound. The calendar, not the contribution size, is often the dominant variable. This is not an argument for perfection. You do not need to pick the right stock or find the perfect investment before you begin. You need to begin with what you have in the vehicle available to you, and then you need to continue. Buffett has expressed repeatedly in various forms the idea that it is not about timing the market. The attempt to find the perfect entry point, to wait for the dip, to predict the correction, to outsmart the collective intelligence of millions of other participants almost always results in less wealth, not more. Because the years spent waiting for perfect conditions are years the money spent sitting still. The second lesson is about what you actually own when you buy a piece of a business. One of the most distinctive aspects of Buffett's philosophy is the way he thinks about stocks, not as ticker symbols, not as lines on a chart that go up and down, but as fractional ownership in real businesses, companies with employees, customers, products, expenses, cash flows, and futures. This distinction matters enormously in practice. When you think of a stock as a piece of paper with a price attached, your attention naturally goes to the price. Did it go up today? Is it going up tomorrow? What is the trend? What is the sentiment? These questions do minute, and the behavior they produce is reactivity. Buying when price momentum is positive, selling when it is negative, following the crowd in both directions. When you think of a stock as ownership in a business, entirely different questions emerge. Is this business selling something people will continue to need? Does it have advantages that competitors cannot easily replicate? Is it run by people who are capable and trustworthy? Is the price I am paying reasonable relative to what this business actually earns and is likely to earn in the future? These questions are slower They require research and patience and a tolerance for uncertainty, but they produce a fundamentally different relationship with the investment. You are no longer guessing about what other investors will do next week. You are making a judgment about what a real enterprise will be worth over the next decade. Buffett has illustrated this by describing his ideal holding period not as a quarter or a year, but as indefinitely for businesses that continue to perform well. This is not stubbornness. It is the logical conclusion of the compounding principle. If a business is genuinely excellent and you own it at a fair price, why would you sell? Every year of continued ownership is another year of compounding growth working in your favor. This does not mean never selling. It means that selling should require a G. NU9 reason. A change in the business, a dramatic overvaluation, a better opportunity elsewhere, not merely a change in price or a shift in market mood. The third lesson is about the nature of advantage and why it matters more than most people realize. Buffett has spoken extensively about what he calls an economic moat, the structural advantages that allow certain businesses to maintain their profitability over time despite competition. A recognizable brand that commands loyalty, a technology that is difficult to replicate, a network effect that makes the product more valuable as more people use it, a cost structure that is simply lower than what competitors can achieve. Moats matter because most businesses left to the natural forces of competition see their profits eroded over time. A competitor sees your margins, enters your market, prices below you, and gradually takes your customers. This is capitalism working as designed. The businesses that resist this erosion for decades are the rare ones. Investing in a business without a moat is a different kind of bet. You are betting not on enduring excellence, but on a temporary advantage. And temporary advantages are priced accordingly, often expensively, during the moment of excitement, and poorly once the competition arrives. The moat framework applies beyond publicly traded companies. It applies to careers. The person who develops skills that are genuinely rare and genuinely valuable, skills that cannot be easily automated, outsourced, or replicated, builds a moat around their own economic life. They have leverage in negotiation. They have options in the market. They have resilience against disruption. Buffett's investment in himself, his voracious reading, his deep study of businesses and industries, his development of a coherent and tested philosophical framework was arguably his most important investment of all. Everything else followed from that foundation. The fourth lesson is about the relationship between fear and opportunity. There is a counterintuitive quality to exceptional investing that most people find genuinely difficult to accept, let alone to act on. The time when it feels most dangerous to invest is often the time when the greatest opportunities exist. And the time when it feels safest and most exciting is often the time when prices have already risen to levels that make future returns disappointing. Markets are not rational in the short term. They are driven by the aggregate emotions of millions of participants, and those emotions oscillate between extremes: greed during good times, fear during bad ones, in ways that consistently misprice assets relative to their actual long-term value. The investor who understands this has an edge that is not based on superior info or superior intelligence. It is based on superior temperament, the ability to remain calm when others are panicking, the willingness to act when others are frozen, the discipline to step back when others are euphoric. Buffett has described this as being greedy when others are fearful, and fearful when others are greedy. This is not contrarianism for its own sake. It is the natural result of looking at businesses and their intrinsic values rather than at market prices and momentum. When prices fall sharply, businesses that were worth owning at higher prices are even more worth owning at lower ones. The fear creates the opportunity. This is intellectually obvious. Practically, it is one of the hardest things a human being can do. Because when prices are falling and every piece of news is catastrophic and everyone around you is selling, your body does not care about the long-term thesis. It wants to protect you from what feels like danger. The investors who have managed to override that impulse consistently and without exception across multiple market cycles have been rewarded in ways that are difficult to overstate. Not because they were smarter, but because they were calmer. The fifth lesson is about the compounding of character alongside the compounding of capital. This is perhaps the most overlooked dimension of Buffett's philosophy because it does not appear in any balance sheet or portfolio statement, but it is woven through everything he has built. Trust compounds, reputation compounds, relationship compounds. Relationship compounds the person who operates with transparency and integrity in their financial dealings, who treats partners fairly, who acknowledges mistakes, who maintains their commitments even when it is costly, builds a form of capital that is not measured in dollars, but that eventually produces them. There is a reason why capital flows toward certain people and away from others over the long arc of a career. It is not always the most technically skilled, it is not always the most educated, it is very often the most trusted, the person about whom others say, if they tell me something, I believe it. If they make a commitment, they will keep it. This is not sentiment. It is economics. Trust reduces friction. It lowers the cost of transactions. It opens doors that remain closed to those whose reputation is uncertain. And it compounds across decades in ways that make an enormous practical difference to where a person ends up. The discipline required to maintain integrity under financial pressure is the same discipline required to hold an investment through a frightening market correction. It is the same discipline required to save consistently when spending would feel better. At the root of all of it is the same capacity, the ability to act according to long-term logic rather than short-term emotion. Now imagine what happens when someone absorbs these lessons early enough and applies them with genuine consistency, not perfectly. Nobody does anything perfectly, but consistently, year after year, through the boredom of steady accumulation and the fear of market downturns and the temptation of exciting alternatives and the social pressure to spend in ways that signal success. In the first few years, almost nothing visible happens. The account grows. The amounts are modest. The temptation to give up or change course is significant because the results do not yet look like anything remarkable. This is the phase where most people abandon the process, not because it is failing, but because it does not yet feel like winning. But something is happening beneath the surface. The foundation is being laid, the compounding is beginning, the habits are solidifying, the relationship with money is slowly, quietly being rewritten. By year 5, the account begins to have weight. The invested capital is generating returns that themselves generate returns. The gap between where this person is and where they would have been without the discipline. He starts to become visible. By year 10, the transformation is undeniable, not because of any single brilliant decision, not because they got lucky with one spectacular investment, but because 10 years of rational, patient, disciplined accumulation has produced an outcome that looks extraordinary to people who have not watched the process unfold. And more than the numbers, which matter enormously but are not the whole story, there is a quality of relationship with money that these 10 years have built. The panic that used to accompany market volatility has been replaced by something closer to equanimity. The impulse to spend in response to social comparison has weakened, replaced by a clearer sense of actual priority. The time horizon has stretched. The decisions have become calmer, more deliberate, more rooted in understanding than in emotion. This is not a personality transplant. It is the accumulated effect of thinking carefully and acting consistently over time. The person who reaches their 40s with this foundation is not just richer in the narrow financial sense. They have options. The option to continue working because they want to, not because they must. The option to take risks in their career because the financial floor is stable. The option to give more generously, to weather unexpected difficulties, to make decisions based on values rather than survival. Freed. Is the word that keeps returning, not the freedom to buy anything, the freedom to choose how to spend the most irreplaceable resource of all, time. The one thing that separates the person who arrives at financial independence from the person who does not is rarely intelligence. It is rarely income. It is rarely even opportunity, though opportunity is real and unequally distributed. It is the decision to begin thinking differently about money and then to act in accordance with that thinking every day for a very long time. The principles described in this video are not secret. They are not proprietary. They are not available only to people with advantages you do not have. They have been described in books, in letters, and interviews across decades. They are simple enough to be understood in an afternoon and deep enough to require a lifetime to fully practice. The question is not whether you understand them. The question is what you do with the understanding. Every year that passes without beginning is a year the compounding does not happen. Every decision made from emotion rather than logic is a cost that is often invisible in the moment and very visible later. Every dollar absorbed by lifestyle inflation is a dollar that does not work while you sleep. But every dollar set aside consistently at a vehicle designed to grow with the patience to leave it alone and the decide case. Plying to continue through discomfort, that dollar begins a journey whose destination, over time, looks entirely different from where you started. You cannot go back to 18. Neither can the person writing these words. Neither could Buffett once he had already begun. But the next best time to absorb these principles has always been the same answer. It will always be. Not next year, not when the conditions are better, not when the number is bigger or the fear is smaller or the timing feels right. Now, with what you have, exactly where you are. If this way of thinking resonates with you, if something in what you have watched today has shifted the way you see money, time, and the choices ahead of you, then the most useful thing you can do right now is to stay in proximity to ideas like these. Subscribe if this kind of thinking is something you want more of, not because a subscriber count matters, but because the environment you choose to think inside shapes the person you are becoming. Think carefully, act patiently, begin now.